Okay, so good morning, everyone, and welcome to the Macro Snapshot. We are Thursday, March the 20th, 2025, recording this in the morning. All right, I just want to look at, go over a little bit what Powell had to say yesterday and the FOMC meeting, which was kind of interesting and quite a curious sort of market reaction, which we'll try and sort of figure out here. The first thing which I think we have to take away from it was that Powell was emphasized the fact that the FOMC committee is very uncertain. We're living in heightened moments of uncertainty, and the statement actually reflected that with an extra sentence which they added, saying that economic uncertainty was very high, clearly alluding to Trump's policies. Powell did say that the net effect is what will matter most of what he talked about four things: the trade policies, regulation, immigration policy, and fiscal policy. And those four things, he basically said, listen, we need more information on all four of those issues. So trade policy, regulation, immigration, and fiscal. And he said that the net effect is what will matter. So essentially, I almost had the impression yesterday that Powell didn't even want to do this meeting yesterday, didn't particularly want to do a dot plot, because he mentioned that the dot plots is sort of the best guesstimate. And so we have to take all this with a grain of salt. But what we can notice in general, there's a couple of things which I'd like to bring up, is that if we look at the overall sort of viewpoint of the Fed, and again, we have to understand that this is not what will happen, it's the best guess of the Fed. And so I think the important thing here is to really look at the hard data rather than trying to project too much into the future. So we see here, though, a couple of interesting things in the GDP, a pretty significant downgrade from 2.1 to 1.7, so four tenths excuse me, taken away. So the Fed, in theory, is seeing a slowdown in the U.S. economy. Secondly, the unemployment rate ticking up a little bit, although Powell was at pains to say that was not bad really. And then probably what's most interesting is that the core PCE inflation is scheduled is forecast to go up by 0.3. And what's interesting is that even in 2026, that's supposed to be above their target range. And then, of course, we didn't have any change to the Fed funds rate projections, so they remained at 2 cuts. So basically, they had been projected at 2 cuts. They remained at 2 cuts. But so essentially what Powell, the FOMC was saying is that they expect an economic slowdown, but with a little bit of inflationary or sticky inflation. And of course, the one way to look at that is sort of as stagflation, where you have a slowing economy, but you have an inflation rate which is not really coming down, which is not good. That in theory, that should be very bad for stocks. But what's interesting here, and Powell did speak about it a lot, is just actually to look at the dot plots in a little bit more detail, which took me. So if you actually look at it, what they use on the dot plot is a median. Okay, and so what we can see here is that where we are for the yellow lines, these dots are all the 19 dots of the members, right? Which came out yesterday, and the sort of the gray lines is from the December meeting. So what you can see here is that for the 2025, yes, the median remained the same at 2 cuts. But if you could actually see here, some of these much lower projections, you see this one down here, one dot at about, what's that, 3 point whatever, and the other one just under 3.5. So these two have sort of disappeared and have coalesced further up. And you can also see that the higher dots, so more hawkish, there's actually more of them. So what's kind of interesting here is that although the median remained the same, the actual sort of grouping, one could argue, is a little more hawkish. And generally, it seems to have been shifted upwards, even though it's sort of, as I said, the median mathematically is the same. And then also going out to 2026 and then 2027, but especially 2026, you can see that in December, some of these more dovish sort of members have actually sort of coalesced a little bit higher. And another way of seeing that just graphically, to compare that, is December 24 to March 25, which we had yesterday. And again, you can just see, for example, one sees 5 cuts. So now like that person has disappeared. There's absolutely no more 4 cuts and there's no more 5 cuts. So here we had 2 members seeing 4 or 5 cuts. That's all disappeared. and so now we only see two seeing three cuts, whereas we had three seeing three cuts. So significant shift upwards. And you can see, again, it's the same chart, but a little bit clearer. You can see, that some of these more dovish sort of members have actually moved sort of a bit further upwards. And then also what's interesting, if you look from yesterday, four officials seeing no cuts at all. That's gone up from one official seeing no cut. So the point here for me is that what's kind of interesting is that if we look at the way that the Stern market reacted, which is the short term, like the Fed funds futures and whatnot. So first of all, if we look here, this is at the 3 months, the SOFR curve here, and I'll just zoom in a little bit. We can see that the live data is the white one. We can see not a huge change, but you can see that, let's say going out to 2025, the end of this year, it went up. It actually came down. Sorry, this is what I was trying to say. It came down a little bit, so more dovish. And you can see that better if you look actually at the pricing here. This is the number of basis points priced in cumulatively by the end of this year, December 25. And this is a tick chart, so very, very short term. And you can see that as we went into the Fed yesterday around about 2 o'clock, the market was pricing in just over two cuts. So as you can see over here, about 54 basis points. So one cut is 25 basis points, so that's just over two cuts. But as soon as the market had absorbed the statement and the dot plot and everything and Powell, you can see that was very, very dovishly repriced, down about 10 or 12 basis points. And then you can see even overnight here from about sort of 5 a.m. As we speak, I'm doing this about 7:30 in the morning here. We're now down, it's gone down even more, down to about 70 basis points. So we're getting now towards about, what's that? It's almost like three cuts. We can have a look here, 2.77, 2 3/4 cuts. So suddenly we've gone from two cuts to 2 3/4 cuts. And so the question is, that's a bit unusual if the dot plot, even though the median had remained at two cuts, it was a bit more hawkish. So that's the conundrum there. Some people are saying, oh yeah, the market was kind of happy that at least they're maintaining two cuts as a median. Okay. But it seems to me that really what the market maybe is looking at a bit more is those change in economic forecasts, basically saying, we're getting a slowdown and inflation is not great. And so this is a bit of a toxic brew and a lot of uncertainty. So that's kind of interesting. The other thing, which is I've been looking at, just looking over my notes from Powell, is that again, it's sort of interesting. He was asked a lot about inflation, and he even used the notorious transitory word, and essentially saying that they don't really have a good grip of what's going to happen with tariffs. And he's thinking that, until and unless they have more data, that they won't know. And he even said, well, as I said, that, maybe it could be transitory. There could be like a one-off kind of cost. And he alluded to Trump 1.0, where, for example, the cost of refrigerators and washing machines, they went up when Trump first put tariffs on back, in his first term, but then that price subsequently went down. So he seemed to be quite relaxed about inflation and essentially saying, well, we'll sort of see what's going on, but we're not that worried. And he also talked a lot about, he was asked about inflation expectations. And he essentially said that, what did he say? He said the inflation surveys, sorry, I'm just looking for this. Yeah, he said inflation, this is a quote, inflation expectations after the 1 year period remain in range. And essentially saying that, wages are growing faster than inflation. And basically saying that, don't worry, guys. And a lot of journalists were sort of saying, Mr. Trump, the University of Michigan, inflation expectations have gone up. And he came back and actually mentioned this chart here, the 5-year break even, which is essentially, where in 5 years and then the following 5 years where average inflation expectations could be according to the market. And he said that actually was very, very stable. And if you look at it here on a daily chart, it has come down a lot since, has come down a lot. And you could argue in the last couple of days it's kind of heading up a little bit, but if you sort of put that sort of over a longer term time frame, it's relatively stable. And so he seems very comfortable. He also mentioned inflation swaps, which is market-based estimates of where inflation could be. And you see here that he again said that was pretty comfortable. He said 1 year is a little bit sort of choppy. Now the 1 year line is the white line here, which as you can see, going back to, I don't know, let's say middle of August, so going back 6 or 7 months, you can see that actually has gone up from 1.7 currently where we are, like literally this morning, 2.9. So that's gone up 120 basis points. But he seemed to be very sanguine about that and quite relaxed and simply saying, well, stuff chops around, relax. And he seemed to be more focused on some of these other tenors. We've got the twos, the threes, the fours, the fives, going out to the 30s, which in his mind was relatively sort of stable. So my take, so I think when we had that rally in the stocks and the rally in the short-term interest rates, I suppose the market was saying, hey, it looks as though we're going to get two cuts. Powell seems to be fairly happy about the data and the economy, and essentially saying that inflation is relatively sort of stable. But that is at odds with what the committee members actually wrote down in the summary of economic projections. And what we've seen overnight, which we'll look at, is that the stocks have actually started to sell off a little bit, although the short-term interest rates have continued to rally. Just talking about the real economy, it was also pretty interesting that he made several times a net distinction between the survey data and sentiment, which seems to be weakening and indeed is a little bit pessimistic compared to the hard data. And he really said that, the hard data at this point in terms of the US real economy, it seems to be pretty solid. And he's saying that, maybe it's just there's been a lot of chatter essentially about tariffs, and that could explain why people's sentiment is a little pessimistic and why some of the survey data is a little bit pessimistic with the uncertainty. But he was saying that, hey, we at the Fed don't really see the real economy collapsing. And then he also talked about the job market. One of the quotes I made here, he said that the layoffs and job creation is balanced. So he's saying that there aren't a huge amount of jobs being created, but he said on the other hand, there aren't a huge amount of layoffs or people being fired. So he said that the market was, pretty imbalanced. And then he said, well, if that were to change, of course, the Fed could change. So the thing here is that he was saying that the pessimistic sort of surveys and whatnot and consumer expectations was more not so much of a problem of inflation, it was a problem of the elevated price levels. That's a quote, the elevated price levels. So it seems to me that Powell's sort of understanding of inflation is that yes, inflation went up aggressively, but now it's fairly acceptable. But there's a lingering sort of problem of perception that people are sort of much more focused on the high price levels rather than the rate of change, which would be inflation. And of course, you could argue that that's a bit of a technical point because if people are paying more for their eggs, they're paying more for their eggs. But he's trying to put more emphasis to say, well, hey, the price of eggs, so to speak, as an example, is not actually going up in such an accelerated way. So that was kind of interesting. He did seem to be fairly relaxed about that. The payrolls remain solid. And he also said that GDP, yes, is going to rise maybe less than expected, but it's still rising. So Powell's takeaway seemed to be that, it was all things balanced, the higher inflation expectations a little bit, but GDP down a little bit, unemployment up a little bit. So in his mind, which he expressed yesterday 2 or 3 times, that would be that was kind of a wash, so therefore let's not change anything. So maybe trying to be a little bit overly relaxed, but that's so let's see how the market reacted to that. As I say, what we did see is we did see that the equity market, we'll just look at the ES, for example. This is the futures market here. Let's put it on an hourly chart, just to get a bit more sort of information about that here. And what we can see here on the hourly chart is that here's the meeting here. So it did pop for an hour or two, but subsequently we've had a pretty big sell-off here from about 4:30 a.m. this morning. Some people are talking about the Swiss National Bank, but quite a big sell-off there. If we also look at the Euro stocks, we can see that there's been quite a big sell-off as well from the European session, about 4:30 or so. What is interesting is that if we look at let's say, for example, the 2-year, the ZT futures, you can see that on Powell and the FOMC, that did go up, and actually that has continued to rise. So the front end of the curve is doing very, very well. And obviously, enjoying the fact that there are still apparently 2 cuts. But as I said earlier in the video, pricing in now 2 3/4 cuts. And so it seems to me that now that the market's kind of digesting things a little bit, could there be some profit taking in Europe? And again, I'll just put this back on a daily chart. We see that, the bill in Germany has been has been passed for spending, and now we have to do the hard work of actually trying to get that into the real economy. It's looking as well as though between Russia and Ukraine that the so-called peace deal is not going to be as easy and seamless and quick as perhaps some people were expecting. And we also had Lagarde this morning. Remember that Lagarde had a speech this morning, essentially saying that because of the heightened trade uncertainty and basically what's going on with U.S. policy, what was her quote? She said it would be difficult to commit to a rate path lower for the ECB. So a little bit hawkish. I have to still look at that speech in more detail, but a little bit hawkish. So it seems to be that little bit of a sort of reality check for Europe. And as I said, we're seeing that in even the German bunds are not doing too badly. But if we look at some of the equity, we're seeing at the German, you see that the DAX is down quite a lot. We see that the Euro Stoxx 50 is also down. And as I say, looking over in the US here, we're seeing, let's say, for example, NASDAQ, well, not down too much, and the ES down a little bit. So just a sort of cooling off a little bit. Now, could that just be some kind of shenanigans in early European markets? Well, we shall see. But it is interesting to me, the bond reaction, really sort of signaling here a little bit of a slowdown and not that worried about inflation. If you look at some other markets here, if we look at the dollar as well, the dollar actually doing quite well. So again, this interesting thing that the bond market rallied, so pushing down the yields, but the dollar doing well. So if we look at the different currencies, we see the dollar index doing pretty well. We see the euro down, quite a bit, really, 50, 60 basis points, again, being rejected at that technical level. We see the Aussie down. So we have the euro down, we have the Aussie down. So if you look at the Japanese yen, actually doing well. So the Japanese yen actually up against the US dollar here. What is interesting overnight, well, actually, the other thing to look at here is the Canadian dollar. There's been talk that there's going to be an election called by Mark Carney, the new Prime Minister, for late April. And the Canadian dollar selling off. I don't know if it's selling off on that, but it's kind of at the same time. And the idea here is that Carney maybe, is a liberal as opposed to Poilievre, who's a bit more of a conservative. So maybe the market not liking the fact that, there's increased chance of a Carney victory. We shall see more about that. Or the other thing, though, is that potentially the market now is really saying, okay, we've got the Fed out of the way. Russia and Ukraine is probably going to grind on the peace negotiations. And then, Trump, is continuing to talk about the day of Liberation Day, which is going to be April the 2nd, which is now only about, essentially about 2 weeks away. And so is the market now suddenly getting back to thinking like, in some shape or another, there will be tariffs placed on emerging markets, possibly on Europe, possibly again, China, Canada, Mexico in a couple of weeks. And this is not good, whichever way you sort of cut the cake. This is not good for global trade, and it's not good for risk assets, and it's not good for equities. And so that could maybe be an increasing attention of the market. That could be a theme. The other thing this morning is that we got the Swiss National Bank. So the Swiss National Bank, they cut 25 basis points, but the governor, Schlegel, he essentially said that that might be enough for the moment in terms of cutting. Inflation is coming down, maybe even coming down to a worrying level. And we did get, as I say, a pretty huge sell-off. If we look at the 3-minute chart here, it is interesting that if you look at, let's say, USD Swiss franc, you can see when the decision came out that the USD rallied a lot against the Swiss franc. So the Swiss franc selling off quite a lot there. But also what's interesting is that if you look over at the stocks, we can see that is the moment really when the Swiss government came out that stocks sold off in Germany. And then also if you look in the US, look at the ES here on a 3-minute chart, we had a very aggressive sell-off, a pretty nasty sell-off. And so one of the theories floating around is that Schlegel at the Swiss National Bank mentioned that currency intervention, FX intervention, was definitely a possibility. And who knows if they wanted to, maybe they want to strengthen the Swiss franc at some point. Now we know that the Swiss National Bank is one of the world's largest holders of equities, and I actually dug up a quick chart here, basically showing their holdings in equities. And what you can see is that the Swiss National Bank, for example, the tech stocks, like you look at Apple here, they own almost $11 billion worth of Apple, Nvidia 9 billion, Microsoft 8 billion, Amazon 5 billion, Meta 3 billion, Tesla 3 billion. You get the point here. the Swiss National Bank has a massive portfolio, market value 150 billion, of tech stocks, and there is some idea here that, in order to raise US dollars, so the process would be to sell some tech holdings, some stocks, in order to get the US dollars, and they could use the US dollars then to basically support their own currency by buying Swiss francs, essentially, by selling the US dollars, which they have, and buying some Swiss francs. Who knows if that's part of the plan? And maybe, but it seems maybe the market was thinking somehow that there could be some sort of deleveraging or selling, essentially, of their positions from the Swiss National Bank. It's just kind of curious that when that decision came out, the equities sold off hard. I'm not saying that's the case, but it's interesting. We'll keep an eye on that. So just in terms of some other things, we see that oil remains, just very quickly here, guys, running out of time. Excuse me. So you see, just want to look in some of the commodities. Let's see how they reacted. Oil remains very weak, the price action. I've just annotated my chart here. This to me feels a little bit potentially like a bull flag. You see these two rallies failing here. It would not surprise me. It's just finding it very hard to have any upside momentum over the last 2 or 3 months. If you look here at the measured moves, this is the Fibonacci extension. So if you look at this one here, going back to the middle of January, and even a shorter term one, both of these Fibonacci extensions measure down to new lows. We do have, this uptrend line here and some new lows. It would not surprise me at all if we just break to the downside on this bear flag, or what I think could be a bear flag. Just kind of get down, measure out some of these Fibonacci extensions, and just sort of make everyone puke out a bit of selling here, run all the stops, and then maybe stabilize around about 62, 63, 64 bucks. I think down here, oil will be quite an interesting buy, but I think at the moment the price action is pretty weak. And if we start getting Trump imposing tariffs on everyone, this is not good for global sentiment and global trade and growth. So that's probably going to be weighing down oil here, as I say, for a little bit, until and unless we get clarity on global trade and Trump. Final thing, just want to look at the precious metals. If you look at gold, it actually reached, looking at the spot market here, the top of the channel. So that's interesting. Now, just taking a bit of a pause here, got to the top of this sort of uptrending channel around about 3,050 bucks. Still no reason particularly to be selling gold, but I mean, it's very difficult to be buying up at this level. So again, it's the usual thing of maybe looking for some kind of retracement. Again, it's tricky to pick that. If you look back here, personally, I had a retracement going back, looking to pick up gold at 2,800. We never got there, and then took off again. So it's one of these things, you have to start sort of playing with, sort of levels and, Fibonacci's, and you say, well, okay, could this be the pullback level? Do you draw a Fibonacci maybe from here? This one looks like an interesting level again for sure, 29.20. We'll keep an eye on that. Something else which just quickly got my attention is copper here. You see the copper had a pretty impressive breakout. But now coming up to, this measured move here on the Fibonacci extension is starting to get into sort of the finish completion kind of zones, in the red here, which also coincides with the recent high of around about $5.20 or so. But what is interesting in copper, you say, well, why is copper sort of breaking out so much? Is there like global demand, China, huge infrastructure projects? What is interesting is that copper, and the chart I showed you is copper over in New York in the COMEX. And just a quick thing here, just keep in mind, is that look at the premium of a COMEX copper in the US, which is the white line, over the London Metal Exchange, which is the other significant market, well, in London, obviously. And that spread, which is normally very, very tight, you can see down here going back almost a year. Look at the spread here. The spread has absolutely exploded in the last couple of months. And you can see this is the spread now, up to over 60, whereas normally it's essentially between 0 and 10, as you can see here. And one of the reasons for that is that a lot of traders, they're fearing that Trump and Navarro, the trade czar, have talked about quite significant tariffs on incoming copper imports into the US. And so a lot of traders are sort of physically shipping copper into the COMEX inventories, so the COMEX warehouses in the US, which is creating a bit of a squeeze and a premium, and that's pushing the price up. So my point here is that copper, I don't know how much of this this price here in copper is genuine demand and genuine sort of clean market mechanics, so to speak. I think there could be a squeeze here. So all that to say, this could be an interesting sort of short sell here. Again, it could keep on squeezing. Again, there's headline risks of copper tariffs and whatnot, but it's definitely come a long way. And just as I say, technically, that is looking like a Fibonacci extension. If you measure it from, let's say, the 2nd of January, the beginning of the year, that looks as though it's coming to an end. So somewhere around about 525 or so, if it just sort of wants to spike up, break a few stops, that could be an interesting sort of tactical short, kept on a short leash. Okay, guys, I'll keep it there. I'll keep it short and stop there. So thank you. I hope that was useful and have a great day. Thank you.